Welcome, everyone. My name is Bethany Hale, and I'm head of marketing here at Cedar. Apologies in advance for the late start today. It's Friday. That's all I can say. I don't know. But in any case, thank you for joining us for today's Cedar Talk featuring Max Levchin. So the wait will surely be worth it. As a reminder, Cedar Talks is our thought leadership series focused on highlighting experienced entrepreneurs, tech innovators, and healthcare leaders who are solving important problems by challenging the status quo. Today's virtual event will conclude in about an hour. Our speakers can't see or hear the audience, but please feel free to use the chat function in the Stage tab to post questions or comments. We'll plan to save some time at the end for a few audience questions. So before we get started, a couple of quick plugs. First, if you like today's Cedar Talk and you want more, you can sign up for our mailing list and register on the events page of our Cedar website. Our next Cedar Talk is coming up on April 28th with Anish Chopra, America's first CTO. And we're speaking to Eric Kanariwala, CEO of Capsule, on May 18th. And secondly, for those looking for a new opportunity in a mission-driven organization, Cedar's hiring. So today we have a member of our recruiting team available to answer any questions you might have on careers at Cedar. To get in touch, just hop over to the Expo tab and you can start a chat there. So now I'd like to introduce this afternoon's participants. Leading the interview is Cedar's co-founder and CEO, Florian Otto. And today's thought leader is Max Levchin. Max is the founder and CEO of Affirm, which is a financial services technology company. He's also the co-founder and chairman of Glow, a data-driven fertility company, and he's the co-founder and general partner at Sci-Fi VC, a private venture capital firm. And I officially feel really embarrassed that I have never started a company because this is a pretty impressive resume. Max was one of the original co-founders of PayPal, where he served as the CTO until its acquisition by eBay in 2002. Max is a serial entrepreneur, obviously. He's a computer scientist, a philanthropist, and an active investor in more than 100 startups. Thank you for joining us today and sharing your experience with us, Max. So Max and Florian, please join us.
Thank you so much, Bethany, for the kind introduction, and welcome, of course, Max. Really appreciate you being here with us. And as I think for all of your audience, as you of course know, it's a very normal time and a very normal space. And this is also the first Cedar Talk that I'm hosting here from a hotel room, and where Max is based. I think it's 6 a.m. in the morning. So we of course deeply appreciate you making the time, Max, for doing this. So let's dive right in. Max, you're an entrepreneurial hero. I think not only to me, but for also a lot of other people, especially immigrants like myself and you as well. And I think many of us are interested to learn a little about your career path. Prior to founding Affirm, you've had a rather illustrious career from founding companies like PayPal or Glow, and serving also on boards like Yelp and Yahoo. Can you just talk a little bit about that journey?
Sure. Thanks for having me. Hopefully, everyone can appreciate my mood lighting at 6 a.m. That's the most I can muster in terms of natural and unnatural light. So these questions are always fun to answer because it ends up being sort of a memory lane trip. And I always try to remember something that's different. So first of all, my whole entrepreneurship sort of a trek was a total accident. I was on track to get a PhD in computer science, and I was actually in the middle of my undergraduate, but I'd already planned out what my thesis was going to be in. I knew who my advisor needed to be. And so I was very hard at work, just sort of accomplishing the goal of being a computer scientist for life. And these two guys kind of talked me into helping them start a company. It wasn't even so much a co-founder. It was just sort of like, hey, you're the best coder between the three of us, and you seem to have a free Friday night. Let's go start a company. And sort of like, I don't know what that is, but I heard about it a little bit because I was at the University of Illinois at the same time as the guys who started Netscape were in the same school. And so this kind of a brush with entrepreneurship nearby derailed my computer science career. Needless to say, I lasted as long as my bachelor's degree could, and ran away and moved to Palo Alto and everything else. But it was a total like, yeah, you know what, maybe for a couple of days I can hang out with you guys instead of, drilling into whatever book I was trying to understand. And then the reason for it, incidentally, is this sort of entrepreneurial zeal vis-a-vis immigrants' desire for safety. And when you come to a country, so I came to the US as a 16-year-old. My parents were academics, or at least sort of highly educated engineers, scientists. And so I was programmed from birth to go get those degrees, get a PhD, and the highest achievement was a Nobel Prize. Like in my family, it was talked about in hushed tones, where if you really, really make it, Nobel Prize is kind of like that's the unattainable but desirable. And mostly because my grandparents were all physics PhDs. And so this whole entrepreneurship thing initially was met with a lot of resistance in the family, and I was told it's an interesting thing to play around with, but obviously a couple of years from now you have to go back to school and get your doctorate and work towards that Nobel Prize. Needless to say, I did nothing of the sort. The winding path to where I am now has kind of always been influenced by this idea of science, though, and not as far as sort of computer science and research is concerned that way. But when you study something deeply and you really like it, you start confusing / liking valuable and challenging. So when I was in college, I would always sign up for the hardest classes, and I would always want to go the plus curriculum, or whatever it is I could get my hands on that would be hard. Like I really wanted to break some hard puzzles, and I sort of conditioned myself, and maybe it was conditioned by my own family, that nothing worth doing is easy. If you're going to really do something, like, you better prepare yourself for, like, it's going to be a grind, it's going to be hard, you're going to have to stay up all night, all that. And so as an entrepreneur, actually, I think suffered / did a lot of extra reps that weren't necessarily essential, because I was always looking for that really, really hard problem to solve. And the thing that sort of led me to where I am now, and PayPal and lots of things in between, was this idea that, or the reality that payments is really hard. Like, it just turns out to be this gnarly kind of a fractal thing where the more you kind of peel the Band-Aid, you're like, oh my God, like, it's even worse than I thought. Like, it's more broken than I thought. There's more problems, more challenges. This stuff was built in, 15th century dark ages technology. And like, now I'm trying to fix it. And so in many ways, I keep on coming back to payments, because it's one of the areas that I know where valuable, there's a lot of money changing hands in the world, and it's important to make it better, but it's also just really hard. It's one of these things that just never gets easier, which, in some weird masochistic way, I really like. So that's sort of the philosophy and how I got here. There's lots of interesting steps that took place in between. After PayPal, I decided that I will never do payments again, because it's just too hard. Like, I'm never going to touch that stuff. And for about 5 or 6 years, I was dabbling in media and entertainment, and even things like video games, which I'm uniquely unqualified to do. It's also very hard, which is why I enjoyed it. But 6 years in, I'm sort of like, wow, I have not really played video games before I got here, and what am I doing trying to build them? But that was the intermission between PayPal and Affirm, really. I'll stop ranting there, but that's a different cut at the journey.
Yeah, I love it, and I really appreciate you always trying to go and really trying to solve the problem, the root cause of it, and of course trying to have scale. And that's the beauty on payments. Literally 100% of the people somehow do payments, and if you improve that somehow, you're touching millions of consumers, or in our case, of course, patients, which is, I think, very motivating. Can you maybe tell us a bit more about Affirm? So you founded Affirm in 2012. What was the ultimate vision and problem you wanted to solve? Because I think as an entrepreneur, in the beginning, you are really bugged by a problem. And then I would love to hear also on how do you feel that you accomplished that vision, or was there any new path, kind of, some people call it pivot, or maybe a new path that emerged along the way?
Sure. And so I agree and disagree with you in the sense that I think sometimes you're very lucky where you kind of walk into a wall where you think the door should be, and you're like, wow, that was terrible. And that can be very inspirational. And you sort of like, all right, well, it's my job to cut the wall and build a door and, make it better. And sometimes I've had those epiphanies, but more often than not, I think I'm too dumb. I just kind of walk up to the wall and go like, I want to get through. Like, I want to get through. And I sort of beat my head against it for a while. And then sometimes the wall cracks open and there's a door after all, but a lot of times no. And so in my case, I find that sort of starting moments are always these kind of more organic exploratory things where I meander through a labyrinth, and where I think there's a door, there's a window. I don't know. I've killed the metaphor, and so I'll get back to a descriptive version. But the way it firm began was I was hanging out with this guy Nathan Gettings, who has kind of he's a very, very private guy. So I'm sure somewhere in the world he's shaking his fist because I even mentioned his name. But he was an unbelievably important sort of character in my life over and over again. So he and I went to college together. I think we knew each other in high school. But he was one of these, like, in a short list of people, you know, who are definitely smarter than you are. Sort of like I try to maintain that list because it sort of keeps me grounded a little bit. And so there's definitely, you know, a short list of people that I know personally who are like, yeah, like he's in a different league. Like he's just much more intellectually superior. And so he was a friend in college, and then I recruited him to be my chief risk officer at PayPal. And so a lot of the early PayPal success that's been well documented now is these sort of inventions around fraud management and dealing with, you know, security issues and things like that. And he and I work very, very closely together. And, you know, his accomplishments are kind of the foundation of a lot of that stuff. And so after PayPal, he went off, and he often goes on these crazy trips where he disappears for a year and then sends you a postcard from, you know, North Korea or Galapagos or someplace like that. And so he's a fascinating character. So he was somewhere in his travels, and then was passing through town, and I saw him live for an unusual conversation. And we got to talking about PayPal, and he said, one thing that's always bugged me is how come you and I never tried our hand at lending to consumers? Because both of us were from, you know, I was from immigrant family. I think he was born in rural Illinois or Minnesota, actually, on a farm. And so we both had non-existent / in my case, trashed credit histories. And so even after PayPal's IPO, when we were suddenly, you know, wealthy beyond our wildest dreams, our credit rating didn't change. We really couldn't, or I couldn't buy a car in any other way except for wiring the money in cash, even though I was suddenly no longer struggling to figure out how to pay off my next student loan payment. And so we got to talking where it's, why do you think that happened? Like, you know, at PayPal, we had access to all this data. We knew if consumers were good for the money or they couldn't afford a loan. And yet we'd always said, you know, credit cards are the source of funds, and PayPal will just transfer the money. Like, shouldn't we have touched that space? And basically it evolved into a conversation around, well, the credit scores are kind of stupid because you and I both had this experience where we were suddenly financially prima facie completely okay, and yet our credit rating ability to borrow didn't reflect that. Shouldn't there be a better way to score credit or to think about this? And that was sort of the abstract conversation about it. And then we sort of one thing led to another, and we basically started building what would look like a new FICO score, something that would take into account that not everybody's cut from the same kind of a standard path, you know, from high school to college, from college to student loans to first job. Like, yeah, that really works. But if you're an immigrant, maybe you never went to high school, or in my case, I went to the last 2 years of high school. And so building a different way to score credit was kind of the original wall that we ran into. But more than anything, complaining about a bad experience we had 20 years ago. So maybe it took me 20 years to recall a problem that presented itself as an opportunity. And then as we started building it, we actually felt pretty good about the data we could acquire in open sources and sort of a quasi FICO replacement. And then said, well, how do we distribute this thing? Like, how do we actually put it to work? So we went to talk to a bunch of people that were doing lending. And the answer was universally, no one will use a credit score that no one else has used, because taking a risk on a credit scoring algorithm that may turn out to be wrong or bad is just a non-starter. Like, we'll, you know, if you're a banker or you're a, you know, private company doing lending, like, that's just a bad idea. We'll never do this. And so we, you know, 3 months later, 6 months later, I don't remember anymore, we sat down and sort of said, all right, so we have this thing, we think it's a better credit score. How do we actually do something with it? I said, well, all right, I guess we'll have to understand how to lend. And so we found another friend who ran a small online shop and said, what if you put up At the time, Affirm was still operating under the name Project Expedite, and it's a long and different story why it had that name, but we had to give it a name that wasn't quite Project. So we called it Affirm, and we asked our friend to offer it right alongside credit cards as an alternative and set up kind of a haphazard lending thing underneath it, basically a credit card replacement using our own credit scoring algorithm. And two things happened. One, it immediately started showing traction. So our friend, the merchant, said, hey, it's kind of amazing, but right alongside credit cards, your logo, which is absolutely unknown and no one knows what this is, people are actually clicking on it and they're trying to use this product. And it was clunky and nothing really worked very well. But two, it made me go research online and offline, in particular offline point of sale lending, which until that moment, I had like a very vague memory of when you go to a Macy's or a Gap, they will tell you, hey, take out a credit card. Like we have a credit card with a store name on it, and it's also a Visa or a MasterCard, and you get some benefits and you maybe get, some, 0% loan to start your credit card. And so I had it all in the back of my head. And then it's like, all right, so this exists. This has been done before. I wonder if it served its purpose. When I dug in, I realized that it's like the worst thing that's ever happened to humankind, basically. It is somewhere between evil and like borderline criminal, where anytime somebody offers you a credit card at the point of sale and they tell you it's a 0%, it is not 0%. It's designed to trap you and later on charge you massive retroactively compounding interest. And all kinds of crazy features apparently have been invented basically to harvest consumers' either desire to transact or lack of understanding of how financial services really work. So that was the moment where my brain kind of went from like, oh, cool science project playing with credit scoring for immigrants and people who don't really understand how this whole thing works, to like, oh my God, the point of sale lending thing. First of all, it's a giant, billions and billions of dollars of volume and many, many cards issued. Completely, I don't want to insult anyone. Hopefully, if this is their past or their future, but it's somewhere between amoral and less so. And I think in healthcare payment, you see, characters in that space too that I think are not exactly savory. And so we sort of suddenly acquired a mission where I went from let's find a way to score credit better to let's try to build something where consumers understand exactly what's going on. And the standard punching bag in payments and lending in particular is, oh, the rates are too high. And part of my conclusions at the time was actually rates don't matter at all. If you understand what you're going to pay, at least you know what awaits you. If you're being told it's going to be free and it's not going to be free, but you have no idea what the number is going to be, that is by far the worst, because not only does it stress people out because they don't fully understand, they just know they're getting something they don't want, to all the way to potentially, driving people towards bankruptcy. And again, healthcare payments is something that today we do precious little of, but it's one area where everybody knows bankruptcies are directly triggered by healthcare payments that go awry. So I'll stop there, but that's sort of the journey for me was interesting. I wonder why we never touched this, to like, wow, like I can carry a banner for this for the next 50 years and never get tired because it's so large and so broken.
Yeah, thank you for sharing that. And it's fascinating. There might be two stories I want to share with you, because I think you're always interested in how this applies. So the first, when I moved to the US, I was not bankrupt by any means. I was totally fine. I wasn't wealthy, but I was normal. I was not able to get a credit card whatsoever. I had cash on my bank, but I was not able to get a credit card until I at some point found, I think it was Fidelity that gave me a credit card, but none of the normal issuers were giving me one. Made absolutely, of course, no sense. And then the second thing, I think what is very interesting, and we might go down a bit deeper at some point and can nerd about this, is the FICO score. So we did analysis, of course, here at Cedar on patients paying the bill or not, right? And there's absolutely zero correlation to the FICO score, but it's zero. It's not even a little bit correlated. So very interesting. And what we found is that the biggest problem is literally this transparency problem. And it is absolutely heartbreaking to see that a lot of these rules are made to literally have poor consumers or financial illiterate just guiding the wrong way in order to enrich somebody's pocket. That's my strong belief in that. And I would love to hear a bit more from you, Max, because I think that was also a bit more of the vision and the values, of course, of Affirm, is to give this transparency and make it fair. And as you say correctly, if something is expensive, but there's a price tag and you know what you're paying for, it's totally fine, right? Can you just tell us a bit more about the challenges and, of course, and opportunities in bringing on more transparency into this consumer financial space?
They are significant in the sense that both the opportunities and challenges are very real. So, I mean, I think the immigrant stories are legion in a sense that everywhere I go, I tell someone, when I came to the US, blah, 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 there's always at least 3 people in the room that say, oh, when I came to the US, I had this stupid thing happen to me. And, they wave their, secured starter card or their 1% cash back and $100 per year fee card, and like all the different ways the industry has invented to kind of make money when people least expect it. And so the more I learn, the more I'm convinced that what the world needs is absolute clear transparency. Actually, the notion of financial education is really, really interesting. This is a little bit of a side topic, but I think it's very relevant. I'm pretty skeptical when it comes to consumer financial education, or at least I haven't found a way to do it. And here's my point. When you survey people, so one of the things that a firm does, which is, it's not controversial, but it's a little controversial. We do not charge late fees. So if you're late, we will remind you, we'll text you, we'll poke you, we'll, not physically poke you, but we'll do our best to say, hey, you forgot. And the theory behind it isn't, we don't care about on time. Obviously not. We don't get paid at all if you don't pay us. But the reason we don't do this is because, having done lots and lots of research around kind of what really happens when late fees are charged, it's either because someone is a sloppy payer and then charging them a late fee will remind them, but you can also just remind them. And then most of the time they just say, oh, sorry, I'll become current. Or people really had something happen in their life and they just can't pay. So charging them a late fee right now is a little bit like telling them, hey, you've been hurt, so I'm going to hurt you some more. Or, you lost your job, so you owe me more money now. And then, so there it just seems like a pointless idea. And then there's a meaningful but small subset of people that said, I have never had any intention of paying you anyway. So late fees or no late fees, I'm not paying, sorry. And that's, you can call it fraudulent, you can call it a bad credit decision, but whatever it is, you're not going to convince them to do something that they're not going to do. And so as a result, I've sort of always netted out in my analysis that charging late fees is just a way to make more money for people that choose to do that. And that may be right for their business, but we opted out. And so so this is all preamble to, so you would think that consumers would look at it and say, oh, wow, cool, Affirm, no late fees. I like it, it's a great idea. We would do a survey of our customers every year or two and ask them. So these are customers that have transacted with Affirm and have never been late. And when we would survey them, we would ask one question: does Affirm charge you late fees if you were ever to become late on an Affirm bill? And full 50% would say yes. And so how hard is a financial education can be if a customer that has signed up and seen a truth in lending disclosure, which we go to great pains to make it as blunt and as transparent, as clear as possible, and in real lettering it says there, if you're late, there are no late fees, don't worry about it, just please pay on time as soon as you can. People just gonna go like, sure, and move right along and don't remember, which is to suggest that I don't think most normals look at their financial education needs and say, I just don't know enough about what my credit card will charge me, or I just don't know what the late fee calculation is going to look like, or does a minimum payment get me out of debt, or does it keep me in debt? Like, all those questions are very basic financial education matters. And yet people kind of go like, I'm not really going to think about money. People, in fact, even more kind of a regressive thought perhaps is that I don't think people like thinking about money. I think they like thinking about things in the context of buying, and they sometimes think about money in the context of earning, but the two rarely meet. And so a huge part of how we design products is actually around this idea of, we know what you want and we want to make sure you learn a little bit. So it's a little bit more force feeding perhaps. I don't think the world is jumping up and down saying, teach me more about money, I'd like to learn. I think most people are kind of going like, I need this procedure done, or I need to buy this couch, or I have a bicycle that I'd like to own. I would like to pay for it if and when, and on sort of, there's hope on the flip side though. So people who call us, call center, and say, I'm late, I'm so sorry, I got your notification, but I'm already behind. What do? Of course, our call center operators say, like, well, please pay on time. Could you pay now? And majority of them say, yeah, of course I can. And they ask, like, what's the late fee? And like, oh, we don't have late fees. Like, but no, really, like, what are you going to charge me extra? Like, we don't charge you extra. We just, like, you owe us $100, please pay $100. And as soon as that happens, people's head blow up and you're like, oh my God, like, you're the only ones. It's actually not true. The industry, I think in general, is shifting towards no late fees and no deferred interest and those sort of nasty things that have been invented over the years. But the best branding moment for a firm has always been with the people who are like, I'm late, what do? Like, just make the same payment. Nothing else changes. And then that is just like unbelievable. I need to tell my friends and all that stuff. So that is that is my somewhat sad opinion on financial education. Every year doesn't go by without at least one financial education company going out of business because they just don't seem to catch consumers in the moment when they are open to learning. And so one of my unfulfilled dreams is to create some sort of a product or a company that allows people to explore, allows an entrepreneur to exploit the moment of, I'm late, I'm primed for learning, I want to know what happens to me. Like, this is your moment, please watch this 5-minute educational video or something like that, where we teach you about what late fees are, what compounding interest is, what deferred interest could be, and all that stuff. So that's the, and just one final thought, since I spent a fair amount of time thinking about financial education. If you look at the other category of companies that loves to get started and then go out of business is the mini mints. So if you remember, a decade or so ago, there was a company called Mint. Intuit bought them eventually. It was basically a much more user-friendly way of managing your personal finances. So you would consolidate all of your accounts, give you a really nice dashboard. You could see what's going on in your life financially. And at the time, it was seen as like finally a way to kind of get out of spreadsheets and into a really cool app, and your money is clear and understood. And they got acquired, and so we don't really know what could have been with them. But since many mints have come and gone, and the ones that haven't been acquired have died, and the reason for it is, I think the demand for people that want to have an app to manage all their money, like really look at their financial state, is minimal, and it's limited to people that already have a spreadsheet and track their money in a spreadsheet and are completely willing to do the work. And they're the one group of people who does not actually need financial education because they're already very good at it. They look at a spreadsheet and they're like, oh, I need to move some money from my brokerage account into my savings account. So I think it's again sort of sad, but you have to go where consumer is as opposed to try to pull them over by force. Most people only think about money in either the happy moments of like, wow, I got a bonus, or I really want this thing and I kind of want to afford it. And then occasionally like, oh crap, I've been hit with the late fee. Like, what do I do now? And so part of a firm's mission is to capture and teach / at the very least expose information in those moments when you are borrowing, when you're paying back, when you're late. A lot of our product design thinking goes into like, all right, so that's a moment for a consumer to understand what could have been, what is, how we compare it to something else. And, ask me in 10 years whether it's really worked. And if we brought a generation of people that just know that deferred interest is a terrible thing and they shouldn't pay it and so on, or not. But the jury is very much out. And I think it doesn't change our mission, transparency and honesty in our interaction with our customers, we think is essential. And we think a lot of our partners on the merchant side really care about it now. But I think consumers only care once they've been tripped up. It's very hard to convince someone who has never really had a financial mishap in their life that they should care about transparency, which is an interesting realization.
Yeah, I love this approach that you're taking, that you literally trust the consumers and say, in general, the intent is good of everyone. And that's also, everybody would say, in general, I want to pay my bills. If I have the money for it, if it is transparent and the service was decent, right? Nobody runs out of a restaurant because, unless the food was really bad, right? Then you might run out without paying. And totally agree with you that anything on dinging credit scores, bad debt collection, late fees, how you mentioned it, is not helpful at all. We have seen that in healthcare again and again. When we basically ask some of our clients, the health systems, what do you think you can do in order to increase sometimes heard, you need to do earlier, harder debt collection. And of course, the only thing that really drives is more unsatisfied patients. But if you reduce the friction, and everything is about friction and transparency, then you can really, I think, have better results on everything. And I was really impressed, Max, reading also your S1 filing whenever you went public in January. And you spent a lot of time educating, I think, also the market on that. Why do you do this no late fee? Because of course it's a change, especially I think for investors to understand, how do you even make money right now? Because that is of course the most profitable thing for Visa and MasterCard and all those payment systems. So you're not the evil one, but you still can make money and making everybody happy. So would love to hear a bit more about your experience of going public first, and then also, of course, educating the market on that.
Sure. Probably the most, so full caveat. One, I'm a first-time public company CEO, and what I hear most often from my investor relations comms and legal team is careful what you say. So if normally I speak very freely, but this one where I will self-edit carefully. That said, the process of going public was fascinating. It's first of all, so we did it entirely on Zoom, of course. So normally, I've taken a couple of companies public in the past, just never as a CEO. And so the process itself isn't brand new. And we use the traditional kind of a roadshow, underwriters, everything, not a direct listing, not a SPAC. So it was kind of a whole very, very vanilla and therefore familiar to me just over the last 25 years of doing this. I've been inside them or near them, et cetera. And so that was all great and easy, or at least not easy at all, actually, but easily leanable on past experiences, except I didn't have to put on a suit and fly to a city to do a roadshow and then fly to another city at the same hour and so on and so forth. I did it all on Zoom from actually this very desk right here, never once putting on long pants. So one of my proud claims to fame is that I did an entire IPO from conception to first day of trading while wearing shorts. At some point, I got loopy enough where I would tell investors, I just want you to know, potential investors, I'm not wearing any pants, and sort of pull up my naked knee, and they would freak out a little, but then they were okay. I think we all live in this kind of a strange bubble of weird behaviors are maybe less weird than they used to be. But it went well. The process was really interesting in a sense that it's a fairly regimented thing, right? So you have to you do these things called testing the waters, where you can talk about the company, but you can't show numbers. You can't really talk about price. And then you come back and do a roadshow and you file, and sort of all the stuff is a little bit prescriptive. The most interesting part of it is the roadshow, where you can talk fairly freely about what's going on in the company, how you think about the company, how you think about business philosophy, and that is where the question around, okay, so you don't charge late fees, isn't that stupid, comes up. And kind of the first level questioning is always easy to deflect, where you sort of say like, well, okay, so here's my breakdown. 95% of people who are late don't actually mean to be late, and you can sort of, they're not going to run a restaurant. I use that exact analogy with investors, where I say, hey, like, what is the last time you decided you just weren't going to pay at a restaurant? Like, it's not a lot of money, but like you could just get up and go. And so anyway, so I think that was generally easy. Some of the more kind of a provocative, or you can push on that and say, well, but if someone is really late and they are costing you money, for that to work, you have to price that into other people's rates. So if you charge late fees, you could maybe make it cheaper for those who are not paying late. And I won't go into the detailed answer that I developed to rebut that question, but I ultimately don't believe that that's a rational behavior either. But those are interesting conversations, and it becomes, on Zoom, certainly becomes a little bit tiring, where you sort of have a revolving door of Zooms. There's a moment in time where, and you're still trying to run a company, and so you start at 7 a.m. and you get done at 7 p.m. and somewhere in the middle, you're like, I need 15 minutes to go pee, have a drink of water, and call into my executive meeting. And so that was a fascinating moment in time. big part of why the founder letter and all those sort of IPO materials really highlighted this notion that we're trying to run a kind of a moral animal of companies is because I want the investors to understand that there are things that we will not do, even though they're profitable. And I very, very strongly believe that, and our company was built on this construct of, and this is back to sort of the very first question, but part of why we started this thing and scaling to the size that we have is because we believe that Gen Z and millennials and the generations to come will have a slightly different attitude towards businesses. I think this wasn't from, I read a bunch of studies and sort of told me things like, millennials are issuing credit cards because they don't want to be in debt. And I think that's actually very superficial and not necessarily real. If you look today at our customers, many of them have credit cards. They don't like them. They will tell you they don't like them. But credit card it's a lingua franca of financial transactions. You just pull out a card and you use it because that's what you have to do. So I don't think that's what those studies weren't there to expose the demise of credit cards or demise of credit. They were there to expose the arrival of consumers that care more about the mission and the stance of the customers, the companies they choose to patronize. Sort of like, what is your policy on climate? And what is your policy on racial equality? And what is your policy on equal pay? And all these different things that are traditionally seen as social matters that activists and legislators care about, and companies over here are meant to increase shareholder value. Like they're rapidly blending together. At this point, when you talk to a reporter, it's never the case that they say, all right, well, let's talk about your quarterly results. They also cut in things like, what have you done on social responsibility? And you're in a payments world. What are you doing about access to credit for underrepresented groups? And are you actively investigating whether your own lending is fair, better than fair, or et cetera. So I think there's a lot of bridging of those issues anyway. And it so happens that we started a company 10 years ago with a view that a lot of these products are bad and we should make better alternatives, which allows us to speak to those things clearly in the context of investors and, at this point, public investors. Right now the company is doing well financially, and so it's TBD in the following sense. At some point or another, like every financial services company has ups and downs. It not because of execution issues or anything else. Just macroeconomic waves have impact on us as underwriters of risk, whether it's payments risk, which is somewhat short term, or lending risk, which is longer term. But there are all these ups and downs that just happen in the background, and you go up and down like a ship in the waves. That's when investors typically say things like, all right, well, you were profitable and fine, and we're not yet profitable as a company, but our economics are public and we're doing well. If something should change, one can expect pressure from activist investors, from general public. Why don't you increase your profitability by charging some fees, or doing things that you said you wouldn't do, but times are different. Shouldn't you change your behavior? And I think what's really, really important, has been really good for us well before we went public, but certainly as we're public now, writing down a very clear set of principles to operate on and saying them out loud over and over again to ourselves and to our investors. If you look at our S1 and our various materials around it, we sort of over-indexed on telling our story. Here's our mission, here are our values, here's how we operate with those values in mind, over and over and over again, because we don't want to be subject to, we love the pressure of public investors telling us, hey, what have you done for us lately? But I do not want to be subject to the pressure of, hey, you should change your mission or your stance on late fees or your stance on deferred interest just because the macroeconomic climate has changed. And I think that's, fortunately for us, I think we are skating where the puck is. I think the majority of the industry is going to have to contend with the fact that their consumers no longer see companies they patronize as shareholder value maximizing machines. They also care about their societal impact and beyond their customer base and beyond their partner base. But so in that sense, I feel like we were probably going towards a general trend. I think if we were trying to take or build a firm 20 years ago or take it public 20 years ago, I probably would have been met with a sort of a whole firestorm of what is this socialist propaganda and things like that, which we're certainly not. We're a very capitalist enterprise. We're very happy to strive towards profitability, but the need to spell out exactly what we think is right and what we think is wrong was there from well before the IPO, and the IPO documentation is just if anything, it was a little bit like not quite a victory lap, but a chance to wave the banner of a firm, but none of it had to be changed. None of it had to be sort of invented on the spot. And so if it feels authentic, it's because it's been this way from the very beginning.
Yeah, I think it's fantastic that you're doing it, and also, of course, it depends a bit on what is your horizon. And I mean, just looking at your horizon is probably in the decades on where will a firm be in 10 or 20 years, and not what is the profitability next quarter. And
Yep.
of course, we all understand if you want to have profitability next quarter, late fee would be a very easy tool for that. But I don't think this is good for value creation over the next 5 or 10 years. Because in the end, then you're of course burning the trust with the consumers, which is in the end everything that you have on the business, right? Is that the consumers have the trust with you. And I think that's really good that you're doing it. And I would love to understand, how do you think that these innovations in fintech and consumer payments also impact other industries, like, for example, healthcare, where we are very deeply passionate about?
So I think opportunity is very significant in all sorts of places. Healthcare in particular, I think healthcare is actually, we've talked about it before, and I've still not really formed a super deep set of opinions about what I think that the right answers are, at least from sort of a firm's point of view. But broadly speaking, I think it will sound disrespectful and or condescending, but I actually think it's just sort of accurate. I think most human beings are uniquely unqualified to understand revolving credit accounts. I think that the foundational problem beneath a lot of personal financial problems in the world is the idea of revolving credit. I think this notion of you can borrow and borrow and borrow and then continue to refinance your own debt kind of in perpetuity. Speaking of this event horizon, I think if you actually sit down and had a deep interview with consumers in sort of significant amount of credit card debt and examine their actions to sort of manage it versus their actions as spenders, you'd pretty quickly realize that their horizon is essentially right now just making ends meet and buying things they have to, which is important. And then it's sort of past their natural lifetime, where the expectation is that they may well die significantly in debt and pass their indebtedness to their descendants and or sort of declare a credit card bankruptcy of some kind. And so as you sort of look at that, I think that the foundational problem isn't, well, people are irresponsible and stupid. Like, they're not. Most people do not want to be in debt. Most people do not want to have no idea exactly how they're going to get out of it. But revolving credit accounts invite them into this notion of just refinance your own debt in perpetuity. It's going to be okay because, why worry? And so I think in healthcare, those problems exist as well, although maybe in a slightly different flavor. And they exist kind of everywhere in the US society, and progressively so in other parts of the world, which is actually kind of growing in its credit card acceptance as opposed to falling. And so my part of my attitude is, I think, sparing consumers the need to figure out exactly how exponential math works with revolving credit accounts has been a big, less spelled out but very visible mission of firms. We certainly would love to bring that practice to things like healthcare and other parts of the world. And I think that is something that, if we don't get to it, someone must, because if people revolve on their medical payments, it's sort of taking your physical ailment and turning into a financial one is not a good thing. It sounds. I've seen enough data to know that always ends up in significant problems. That said, the second I start speculating about a firm and in areas where we don't really have a significant play, I'm sure I'm terrifying some SEC minding lawyer somewhere on our staff. So I will bite my tongue there. But I like learning a lot about how payments work in other industries where we don't play. And so I have been reading up on this particular branch of the world as well.
I will save you and change the topic right now. So, would love Max to hear a bit more just about company building in general. As you probably are aware, Cedar right now is in a growth stage company. 200 people right now working with us. We definitely will double again probably over the next year. Just completed a $200 million growth round led by Tiger Global, and of course are right now ready for this next stage. You've, I think, built and launched and scaled a few companies. Are there any sort of advice that you can give us of the do's and don'ts to me and my team that you want to end this with?
I feel like one day I'll slow down enough to write down all the learnings, but I'm not sure they remain the same. So what works today for us may work today for you, probably will not be relevant 5 years from now again. So the one thing that I've figured out, and I think it's helped me after I figured it out in helping my team cope, everything's going to change. And so long as you're growing, so long as you are expanding your overall field of opportunity, roles, responsibilities, org structures, all of that is just going to go out the window. And so whatever major reorg you just did and whatever sort of beautifully arranged chess pieces on the executive board that you have is probably all going to be wrong and inappropriate and incorrect and have all sorts of needs to get fixed. And so anytime you find yourself engaging in deep conversation around, whose area of responsibility is this, and what do you do about overlapping responsibilities? It's important tactical issue to solve, and I spend a fair amount of my time thinking through those things and trying to deal with those challenges internally. But what I found is that if you just wait, 6 weeks, you will find that there's so much new white space opportunity and responsibility comes along. It's just sort of never enough humans, always too many things to do. And I think when you're in a growth stage, it becomes especially daunting because you go from like, wow, all this opportunity to like, oh crap, there's not enough time in a day and not enough engineers in the team, which is certainly my repeating mantra. Let's see, any tidbits of advice? I've always found it to be very strange from within that companies celebrate funding rounds. I think basically, like, it's important to say, hey, we just got funded. So I'm not saying, hide it or don't talk about it. But I do think it's basically this solemn moment where you kind of look at each other and say, we just signed up for a much bigger outcome. Like up until the very moment somebody gives you, I have no idea what your financial metrics were in this round, but if you were $1 billion company and you're about to take $200 million, up until that moment, you can say, we built $1 billion thing. It's amazing. Like, you guys and girls, you're so cool. And I'm so proud to be your leader. It's worth $1 billion. And the second you take the wire with the $200 million, you're like, okay, everything we've done so far is not good enough. Like, in fact, it is demonstrably not good enough because someone just bet that we will get much bigger, much more interesting, much more profitable, much more whatever. And so, like, yeah, you take a tiny victory lap for about $1 billion that we did, and we were so proud of 10 minutes ago, and it's nothing now. It has to be at least $5 billion, $10 billion, whatever these people are expecting to get back from their $200 million investment. That's what we're signing up for. So it's kind of like, okay, well, if you thought you were tired, it's going to get much harder because it is a logarithmic curve. Like, no company in the history of the world grew at a doubling pace forever. And so that means it will get harder and harder and harder to double. And so you're signing up for a much, much tougher journey going forward than the one you've just experienced. And so in that sense, I think just having that firmly in mind every time you kind of reload for the next big growth spurt has allowed me to keep my own team sane and myself sane. This is kind of maybe a very small footnote, and you may already well know this. The one thing that happens as you get larger, certainly in growth stages, many things become too small to do. Kind of say, well, okay, but we have this big thing and it's this machine, and like we're flying this plane, but our plane has not enough engines, and the paint job outside is just not that good, and there are all these things, like we just need to continue investing in the plane. And somebody shows up and says, I've invented a boat. I think we should also build this little boat. And like, I'll just need a couple engineers and a product manager in a corner, and I want to go do that. And lots of companies in the early growth stage that I'm an advisor to or investor basically say like, no. Like the number one thing a startup has is focus. If we are not focused, what are we? Like the reason we got from there to here is because we were so focused and we were so good at executing. No boats, just planes. So we got a plane to paint and build and stuff to add. And I think that's generally right. Except the reason you got here is because at some point you and a small handful of friends basically said, hey, there's no plane, we need to invent it. And so that moment of like, I see an opportunity is a really, really important moment. And if you don't take advantage of it, some startup somewhere else will. Any different boat plane debate conversation is always different. So it's completely worthless to say, and here's the rule, you always build the plane or you always don't build the plane. That's completely silly. But having the openness of mind to say, wait a second, another thing that's not actually contributing to the massive growth engine that we've created where all the money, all the engineers, everything is going to go. Like we shouldn't completely shake that off, because if we don't, that new mode of transportation might actually be more interesting and more important than what we have today, especially if there are synergies in the long term. And for what it's worth, I think the one way to make sure is as you get larger, you have to start asking the question, and same thing said differently, but if you look at your growth, you look at your main product, for a while it was flat and then it started growing and then it's this unstoppable machine. And it's sort of, will it always go 2x every year or will it eventually slow down? Truth is certainly in the future, but past any indication, it will eventually slow down because all things become too hard to double every year. And so that's the proverbial S-curve. And one of the things that I keep on doing at Affirm and all the other companies where I'm involved, and certainly my own past, sort of ask the question, am I prepared to spot, capture, and invest in the next S-curve? Not make this one go 2x every year a little bit longer. And that's certainly very important. Majority of our resources go into what's today, not what could be. Certainly in a growth stage company, you want to double and double and double, but eventually it'll flatten out. And so, and this is not my idea, but one of my kind of more famous investors is Vinod Khosla, and he and I have had this sort of debate around, how do you create more S-curves for years now? And his sort of rule of thumb is spend between 2 and 5% of your company's capital, which is both financial and human, on creating more S-curves. And there's lots of structural ways of saying, these people are over there in a corner, it's the labs, or and in your space and mine, one of the really interesting things is that if you want to invent something brand new, when you were tiny, you could say regulations from regulation, like whatever, no one knows who we are. We're not really going to get tagged by some regulator or some legislator for doing terrible things. We're not ever going to want to do terrible things, but we can make mistakes. We have a lot of openness because we're so small, we don't matter. Once in a growth stage, everybody knows who you are. People know your name. Regulators, legislators, people who oversee your industry know that if you do something, even in a corner, it can absolutely drag down the main plane that you're trying to build. And so how do you build something where you really have white space, really have sort of an open thinking and like not care so much about making mistakes while not damaging the mothership? And that's a sort of topic for a whole hour worth of conversation, but that's something that I deal with at Affirm all the time. But I do believe that if you want to have a 50-year horizon or 100-year horizon, which is what I try to do with my company, you have to ask the question, where will the next S-curve come from? And ideally the next 3 or 4 at any given time. Even as the second one is taking off, you want to start thinking about the third, and et cetera, et cetera. And that's probably the most important kind of learning that I've been trying to put to work.
Yeah, I think it's just fascinating, and we are, I think, in a very fortunate situation where your company and in my company, we are in a very large market. So this first S-curve can go pretty steep, pretty long, but of course, at some point, the next S-curves need to come. And the very large companies like an Amazon or like an Apple have shown they have different S-curves and become this multi-decade company, which is all of our objective. Max, thank you so much for coming. It was extremely interesting, inspiring, and yeah, thank you so much for your time, what you're doing for all the consumers. And preventing a lot of harm in the world. And the best is yet to come.
Thank you for having me.